Very good afternoon, good evening, ladies and gentlemen. Good morning to my colleagues and participants who are joining us from various other parts of the world. My name is Siddharth Talwar. I'm a chartered accountant and I lead the CFO advisory practice for Grant Thornton Bharat. And I'm going to be your host and moderator for the session today. Firstly, a very few words about the context of this webinar. In terms of the background, all of us know that there was no proper standard dealing with insurance contracts within IFRS right up till about 2023. And though there was IFRS 4, it was, as ISB chairman, Mr. Hans Hugerboss had once said, it was actually a stopgap measure, and because it essentially allowed companies to report using their national standards. Insurance companies who own assets worth trillions of dollars, therefore it was extremely important that they report using a consistent standard across the globe. So IFRS 17 was implemented internationally from the year beginning 1st of January 2023. And it is expected that, with its focus on providing investors with updated information versus historical information only, it will provide them with a better understanding of the financial performance and operational performance, of the insurance companies. Here in India, while we converged with IFRS in 2017, several sectors, including the non-banking sector, it moved to IFRS starting from 2018. The insurance sector was specifically kept out. Obviously, the banking sector was also kept out, but insurance sector was kept out, from this convergence regime. And as all of us know, IRDAI has very recently required a select list of companies to adopt IND AS with effect from 1st April 24. Therefore, to share some practical insights and guide all of us with their rich experience as India moved toward this new journey of IFRS 17, we have an excellent lineup of panelists today whom I'm very proud to introduce. I would first like to introduce my panelist, Dhiren, who's the CFO at ICICI Pru. His current areas of responsibility include finance, investor relations, and business intelligence unit. He's a graduate from the prestigious Indian Institute of Management, Lucknow, and a graduate in mechanical engineering from, again, the very prestigious Indian Institute of Technology, Kharagpur. Welcome to the panel, Dhiren.
Thank you, Siddharth. Thank you for inviting me to the panel.
My next panelist is Kunj Maheshwari. Kunj is the head of life insurance consulting within Insurance Consulting and Technology Division of WTW for India and Sri Lanka, and partner at Willis Towers Watson Actuarial Advisory LLP. He holds several statutory and professional responsibilities. Very nice lineup of qualifications and participations. incumbent member on the panel of actuaries for life insurance segment established by IND AS, chairperson of the advisory group on IFRS 17 of the Institute of Actuaries of India, member of the expert committee on implementation of IND AS IFRS in insurance sector by IND AS, and co-chair of the joint study group on IND AS established by the ICAI and the Institute of Actuaries of India. So he's also a member of WTW's IFRS 17 Global Clearinghouse, and he's been working on IFRS 17 projects for several years and done dozens of IFRS 17 implementations around the world. Welcome to the panel, Kunj. Very glad to have you here.
Thank you, Siddharth. It's my pleasure.
My next panelist is Keyur Dave. Keyur is a partner in CFO advisory practice of Thornton Bharat. He's a chartered accountant with over 2 decades of experience in audit and advisory services, including application of IFRS, US GAAP, IND AS, and has handled more than 80 GAAP conversions from various GAPs into IND AS and IFRS. He's also participated in the IND AS Transition Facilitation Group of the ICAI as special invitee at the Accounting Standards Board, as well as Reserve Bank of India's Working Group report on financial instruments. Welcome to the panel, Keyur. And joining me from the West are my colleagues from the UK, James and Natalia. James, who's a partner at Grant Thornton UK within its actuarial and risk team, specialized in life actuarial work for the last 25 years and leads the actuarial and insurance consulting practice at GT UK. His specialist skill is in finance transformation, and he has recently led a very interesting integration project combining finance functions of 2 leading UK insurers. Welcome to the panel, James.
Lovely. Thank you very much. Lovely to be here.
And Natalia, who joins James from UK, is an associate director in Grant Thornton UK's actuarial and risk team. She's a life actuary with over 20 years of experience in insurance industry. Her experience is in finance transformation projects, including Solvency II and IFRS 17, audit advisory and risk engagements. She's helped insurers with various aspects of IFRS 17, starting with standard interpretation and methodology approaches. And she was also the deputy chair of the IFOA's IFRS 17 CSM working party. So welcome to this group, Natalia. Thanks for joining us today.
Thank you. Good day, everyone.
All right. Let's dive in straight into our discussion. And Kunj, let me begin with you, if you allow me. So Kunj, could you give us a brief about the change in the reporting environment for insurance companies with implementation of this IND AS 117? What changes should they really expect?
Right. So in some ways, it's a brave new world for insurance reporting, particularly in India. The IND AS introduces a fair number of new ideas, new concepts, and amalgamates for the first time, really, what used to be a domain of actuaries and used to be a domain of accountants, and kind of, wedges them together in a manner that is unprecedented. So, not only will insurance companies now, from a reporting perspective, deal with new numbers and new methodologies and so on and so forth, they will also learn operationally that, collaboration between finance and actuarial and IT, which may be great in certain instances, may be more sporadic in other instances, will now become very much part of everyday life. So, everyday life will change, and so will the reporting. Particularly from a life insurance perspective, the previous Indian GAAP reporting, as people are well aware, had its limitations, to overcome which a number of insurance companies would report supplementary Indian embedded value. So what IND AS 117 essentially does is it sits somewhere in between of the GAAP reporting and IND AS, of IEV, Indian embedded value, and the profit emergence and so on and so forth is somewhere in between the 2 frameworks that currently exist. So that will be an interesting way of dealing with things, because now people will reconcile not only to IGAP but also to their previous IEV.
Great. I think that's a very interesting perspective. That's the big picture, for all of us. But how do Kunj, how do actuarial teams then approach this transition? You come from that background, and from the perspective of allocating their time, resources, to understand and update the models under IND AS 117? How should, as an actuary, working with so many insurance companies, what is your perspective on this approach? Could you
One
go on
reality
mute?
for the actuarial department is going to be that increasingly the actuarial departments will have to deal with multiple metrics. So already, as I mentioned, we at least on the life insurance space, we were dealing with two by way of IGAP and Indian Embedded Value. On the general insurance side, it was largely the IGAP. But with IFRS or IND AS coming in, that adds an additional metric, and possibly with risk-based capital also coming in for the actuaries, that adds another metric. So increasingly, the actuarial teams have to basically cope with multiple metrics, including IND AS 117. Specifically on IND AS, the models need a bit of an upgrade, and a new purchase is almost required to be able to calculate some of the technical CSM sort of calculations. And there is a need for a large amount of upskilling as well. So nearly across all actuarial departments, we will have need for training, development, learning, new ways of doing similar concepts that we had earlier, but applied in a completely different context. And more importantly, you will find a lot of the finance people working in some actuarial departments and actuarial people working in some finance departments, increasingly so because of the overlap being so drastic. Up till now, the actuarial input into the financial statement used to be one line item, a material line item, but one line item increase in reserve or change in reserves, and that would just sit as it would. Now you basically have multiple line items of the P&L and balance sheet, all relying on actuarial calculations and inputs, which then the finance team will translate into the accounting framework. So you will definitely find a lot of that happening, and actuaries will have to get to grips with accounting norms, and accountants will have to get to grips with the actuarial concepts as well.
That's exciting. I mean, you were almost driving accountants out of business here, but look forward to learning a little more from actuaries. But what challenges, did you face while creating, these calculation engines for amortizing and adjusting the CSM, including the IT infrastructure? Most important part is the IT infrastructure. What challenges are you really seeing on the ground?
So in some ways, as you can imagine, there are fundamental two types of IT systems that now exist in the world. One is systems that go from a ledger solution backward and do all of the actuarial calculations. So systems that were historically more ledger driven, more accounts driven. And the second type of systems are more sort of cash flow systems that actuaries would traditionally use. And they go forward into, computing, let's say the IFRS, and then doing the downstream reporting. So you've got these two almost breeds of systems, if you like, and each one has its own unique challenges. The biggest challenges on the ground on system implementations are, by and large, across our implementations, a lot of the systems have matured, right? So what we see is a large number of systems are maturing because the IFRS 17 globally has been in the works, at least since 2017-18, people have been working at it, and they've gone live earlier this year. And therefore, what you have globally, the systems have matured. The challenge comes on the ground, getting data to feed into the system. A lot of the data is new. Some of the data maybe wasn't being captured, or some of the data fields are brand new and you have to create them for the first time or start capturing them. And a lot of the data granularity is something that is unheard of. So at least in India, the level of granularity that IND AS reporting goes into is completely unheard of. Although we do segmental reporting already under IND AS, we have to go cohort, and just the system challenge of being able to not only calculate but then analyze and output and then finally do the reporting on at very granular annual cohorts with multiplied by 3 onerous, non-onerous, and could be onerous cohorts multiplied by as many lines of business or risk homogeneous risk groups that are there. The granularity balloons up very, very quickly. So that's an important challenge, that the accounting actuals need to flow at the same level of granularity. And the second big challenge is there are a large number of peripheral systems already in place in insurance companies in India. So you'll have systems for doing certain asset recording, you'll have systems for doing premium recording or claims recording. Expense could be recorded in a different system, or investment return could be in another place. What IND AS now requires you to do is kind of bring all of those together in a cohesive manner at a consistent level of granularity. So up until now, we could aggregate from each system and then report the aggregate values, and we'd be fine. But now we need more granular information, and therefore all of the peripheral systems need to start talking to each other in a common platform. So from a system perspective, that amalgamation of multiple peripheral systems along with an actuarial system and several other peripheral systems coming together is definitely a system challenge that need to be overcome.
That's great. And sticking to the actuarial liability part, or which hitherto has been an area, as you mentioned earlier, that actuaries were not really looking into what accountants were doing, and vice versa, and auditors were kind of just taking in that number and plugging it into the financial statement. But now going forward, since it becomes more integrated and cohesive, as you mentioned, so what challenges from a auditability point of view? There's a lot of estimates, a lot of judgment that goes into it. From an auditability point of view, that's going to be a big mindset shift. What challenges you see, on that account?
So one of the beauties of actuarial work is there is a very large volume of work that actuaries do traditionally that relies on actuarial professional judgment. And the moment you have actuarial professional judgment when making estimates, or when forecasting, or when assessing cash flows and so on and so forth, including in methodology as well as in computation, there is a degree of professional responsibility that goes in, which, although it's subject to peer reviews and so on and so forth, it is not formally audited in the manner that, there is no formal sort of, yes, I can reconcile every single line with every other line and so on and so forth. So in some ways, being able to audit areas of judgment, and of course, by definition, judgment means that one person's view could be different to another person's view, and therefore when the auditor comes along, you need that much more of a hill to climb to convince each auditor that actually the judgments applied are reasonable and rationally applied. And the auditors need to be on board with that as well. The auditors can't have a straitjacket checkbox approach anymore. That, okay, yes, tick, 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 tick. I can see, 5 things reconcile with a bank balance and 7 things have invoices against them, so everything must be fine. The auditors also need to be on board with there are areas of judgment, and therefore there is a room for interpretation and room for doing that. And it puts responsibility both on the auditor as well to seek that professional input, where judgment has been applied. It puts the onus on the actuaries as well to now be willing to be subject to that level of scrutiny, which historically in India, the actuarial departments weren't subject to an audit at all. It used to be the actuary would certify the reserves and auditor would say, yes, I've relied on it, and audit closed. Right now, all the models, all the assumptions, all the methodologies are subject to a very detailed audit rigor, which is going to be completely new. Abroad, outside of India, some of the actuarial work was still being subject to audit. So it's not that much of a cultural shift, but it's a big cultural shift that suddenly all of the calculations will be subject to an audit.
I can see my panelists from the industry, Dhiren, and from the profession, Kiyur, both of them smiling, and I'll come to them, both of them to hear their reasons. But one last question to you, Kunj. You've implemented this, in several countries outside India. What's been your experience? What are the, learnings, or what are the global perspectives that India needs to keep in mind?
I'll answer that question in 2 parts. One is the technical and the non-technical part. So the technical part, yes, there are technical challenges of data systems, methodologies, choices to be made, and so on and so forth. In some ways, the technical challenges are the easier ones to overcome. Those are the ones that you can work around, you can work hard, you can get your mind around it, and you can get a computer to do what you need it to do. It is the bigger challenge actually lies in two particularly non-technical areas. One is, do not underestimate the power of project management. It's a long program. It's going to be, it's not a transition that happens in 6 months or less than a year. It takes a couple of years to migrate fully. The project management role across departments and across time is very, very important to keep things moving, which is one of our learnings as well, that you cannot underestimate just the sheer need to bring people together and have an IT person talking in the same language as actually talking in the same language as an accountant. Fundamentally, these people speak different languages, right? So you need a very, very strong project management overhead. And the second is a people aspect where, yes, there is a dearth of, let's say, sufficiently experienced personnel, but at the same time, IFRS fatigue is a real thing. So the people who stay on a project for a couple of years genuinely get tired of doing all of the heavy lifting and so on and so forth. And what you don't want is, you don't want to be keep going on this retraining and training exercise. So you need to be able to take care of the people who've sort of gone through the learning curve. And IFRS fatigue is a very, very real thing. We've seen globally, large programs where the project leads and so on and so forth, at the end of the program, they got so tired that they basically went on a sabbatical for a year or two, and I'll go to Latin America for 6 months. So I've had these cases as well, that people have just got so tired of the implementation over 2 years that they've just needed that break. So that's something that needs to be taken care of, because when you move into BAU or business as usual, you actually need those people who did the 2 years of implementation to be able to do the reporting now, right? But by that time, they're so tired, they've gone, right? So that's a very, very real thing, and companies in India would bear well to kind of keep that in mind from the outset.
Well, thanks, Phil. That's a very real perspective. At least one thing is good, that people can plan their holiday, maybe aligned to the project plan. But thanks for that perspective. I also encourage all our participants to share their questions, if any, with our panelists, and we can take them as we go along, or we can bunch them up and take them in the end. But thanks, Kun. Thanks for all the insights. I'll probably head a little westwards towards my colleagues in the UK. James, let me have you on the stage.
Hello. Thank you, and thank you, Kunj, for that session. So just quickly, I think we've got a couple of slides coming up in a second that we're going to talk to your audience about. But introduction. So I'm James Cruttenden, and as presented, I lead the actuarial and insurance consulting team. And my specialism really is around finance transformation. So it was very much my journey so far in IFRS 17 has been helping getting those processes and some of those systems ready for purpose. And I'm joined today by Natalia Mirian, who is a real expert in IFRS 17, again, as you presented. So what we're going to try and do today is bring a bit of colour of what we've seen in the last 4 or 5 years, but it's really hotted up in the last 2 years. And the more that we can give colour and a feeling of what we've seen, hopefully that will be useful information for the audience. So today we're going to cover the IFRS 17 timeline that we've had in the UK. That's the first item. And the second item is achievements and up and coming challenges. Trying to really build on the market insight that we've seen. But before we get going, and I hand over to Natalia, a lot of good work was done. As Kunj has mentioned, there are lots of building and development and system stuff. So there's been some really fantastic work, and it leaves our insurers in a much better place than they were previously. But just a few takeaways, which we'll bring out as we speak. It took longer to implement than expected. It was actually quite hard work for some of those heavy lifting areas that have been highlighted. It also cost probably more than expected. And that clearly is an area that insurers in your market should think about. where you want to ultimately get to. There are still some tactical solutions in place, but ultimately you've got to drop to your long-term strategic solution. And the other minor point that I just thought was worth sharing is it used more management time to deliver. They got involved later on in the process when they started seeing the numbers come through. And then there was a lot of questions, and it really pulled in a lot of time of CFOs. So those are some of the themes we'll bring out in the next 10 or so minutes. But Natalia, over to you on your IFRS 17 implementation timeline, please.
Yeah, thank you, James. James mentions that the last 2 years in the IFRS 17 implementation process was the most intense. But really, so if we go back to the initial thoughts about the standard, it was probably developing, the standard was developing probably about 20 years until the first draft was issued, first final draft was issued in May 2017. And this was the point when insurers in the UK market started to build up understanding and assessing the ways they could implement it. So the issue of the first draft by ISB in 2017 triggered in early 2018 setting up a transitional resource group, which was the group of the insurance industry leaders who were getting together on a regular basis, discussing IFRS 17 principles. IFRS 17 is a principle-based standard, and how those principles could be applied to their companies and how they could be technically interpreted. So those discussions had feedback to ISB, which in due course resulted in 2019 in amendments to the first draft of IFRS 17 standard. And so the initial implementation day was the 1st of January 2020. And again, largely triggered by those transitional resource group discussions and work that was done at the back of it by insurers in interpreting standard, trying methodologies, finding ways they would apply methodologies to its business portfolios, evaluating software, and assessing the time it would take to onboard that software or perform developments. And again, feedback was given to ISB, and ISB decided to move forward the implementation date to the 1st of January 2023 to give insurers more time until they need to start reporting on the IFRS 17 basis. Further changes were made to the standard, and the final draft in the UK market was eventually issued in June 2020. And this is when the most heavy work began, with companies running at full speed of developing software or onboarding products on off-the-shelf purchased software, making software a big component, making accounting and actuarial systems talk to each other, so developing those bridges so numbers and reports can be seamlessly transferred, and performing dry runs, one dry run after the other dry run, full complete systems end-to-end testing in order to deliver IFRS 17 reporting for the 1st of January 2023. And the implementation, companies continued dry runs and internal quarterly reporting, and after the half year 2023 came, companies for the first time went to the market with the interim reporting on the IFRS 17 basis. The numbers have been published and are being currently looked at the market. the work has not finished. The work has not finished. Companies still continue refining their systems and polishing the items that are still left to polish. And James will mention a few of them in the next slide.
Thank you, Natalia. Brilliant. If we could go to the next slide, please. What I wanted to try and do as I touch on some of the areas of achievement and further challenges to come was just give some market insight. So we've got a backdrop in the UK market that Solvency II, our risk-based capital regime, was finishing. And basically that's a complex metric to calculate, again, as Kunja's referenced. So there had been a lot of work previously done as we went into 2017 through to our current date. The insurers involved in the scope of this work were the listed insurers. So roughly 20 of the big insurers were involved in this journey. But as Kun said, the scale of the implementation was huge. Actuaries, accountants, the auditors, there was more disclosure required in the reporting. But the one thing that I wanted to highlight where I think there was a biggest challenge was working with IT to make sure you had the systems in place to do this data crunching that was required. So that was a huge area. The other thing I wanted to touch on very quickly was the team sizes. I agree completely with Kunja on project management, but often there were project team sizes of over 100 involved. Mixtures of all of those services that I've just mentioned being involved to work through this. Now, some of the outcomes that we've heard over the last year, as Natalia has just said, the results are now being published, but a number of insurers went to the wire and delivered results at 11:57 p.m. on the deadline day, and that's really pushing things. And sat there in the office with your auditor signing off. So some of the insurers really did push things right to the end. The analyst comments in our market have been very, very favorable at this stage. There is a good consistency there, and people are making good and positive comments about that. But there's still a lot of embedding to go. And I'll touch on a couple of those points in a minute. A couple of insurers I've spoken to recently, I wanted to just give you an idea. They're going into Q3 now and reporting on all these various metrics. And one big insurer is trying to aim for an IFRS 17 calculation by working day 20. And if they achieve that, that would be absolutely phenomenal. But I think that that's very optimistic. So they do have a plan B where they'll take the roll forward from the half year. I suspect that will be the likely outcome. And another thing I just wanted to share was around the regulators got involved in this, because the regulator has been very interested in seeing how companies have performed. And one company has a skilled persons review placed on them by the regulator, because the regulator was uncomfortable how the project team delivered on it. They felt it was inefficient. Now, I don't know how that would play in other markets, but certainly we've seen one of those in our market. So just looking at some of the achievements here, clearly there's better modeling capabilities. The models now can really, they have to be fast because of the volume of work, but you've got more detail. So I would say overall, much better modeling capabilities, and the level of detail, the granularity of the reporting, again, is a much better, and you can really dive into what's in there. As I mentioned with the analysts, there's better comparability in the market. So that's obviously a good thing for any listed company. So you can see how you're performing. But I do think there is some internal challenges still to come. And I've just written down two that I want to highlight to you. So data quality, is your data where you need to be? And the management of that. I think the data will drive everything that we do going forward. But in particular, manuals. Insurers, in my opinion, often have manuals. And the more manuals you have, the more complex this is in an IFRS 17 environment. So one lesson we have learned here is how can we get rid of some of those manuals, get them into the models so they disappear. And one insurer I've worked with had over 300 manuals, and because of the allocation of those manuals to different pots and different funds, that sort of went massive, even bigger, even into thousands. And we're working with them to take the 300 manuals down to under 10. That's the ambition. So that's very interesting. The other thing is working day timetable. IFRS 17 has hurt working day timetable. We have to do our risk-based capital quickly. You've got IFRS 17 sitting to the right, often done by a separate team at the moment, and it's slowing that process down. So it's all about how can we do all of these metrics, as Kunj said, together quickly. And so there is that optimization piece. And also, I just wanted to, external challenge is getting the auditors where you need to, because those audit reviews are going to be very detailed. I still think we're at the beginning of that journey, if I'm honest, in the audit review and getting the process completely nailed down. So that's what I'm going to say. Natalia, do you have any others? As I know you've done much more detailed work in this space.
I think I would like to mention specifically amongst the achievements, the achievements James mentioned, enhanced transparency of the reports we are seeing now in the market. So companies, and examples are like companies value reinsurance now separately from insurance. So there is no hidden loss or profit from these two portfolios. The analysts can really see what the insurance business brings to companies, which insurance portfolio is profitable or group of products is profitable, which is loss-making, and what reinsurance, what overlay reinsurance does to it, how it changes. And in respect of upcoming challenges, I think training and skills enhancements of BU teams and companies management should not be overlooked, and it is still in developing stage. And the earlier that training of BU teams begins, the better for insurers, as Kunj mentioned as well. So project teams are tired, they want to be off of the projects as soon as possible, but the insurance company needs to ensure that the BU teams are prepared to take over.
Thank you, Natalia. Thank you. And that was what we've seen. Hopefully that gives a bit of colour on our journey over here in the UK.
Thanks, James. Thanks, Natalia. I think that's really insightful. Just some final view from your side in terms of what you've seen on the ground impact in terms of numbers. Eventually, the investors, stakeholders are looking at numbers. How are you seeing, that flying through? I mean, is it massively changing, the position? How is the investing community reacting to that?
But as I said, I think overall positively, because they've got more to look at and it's more comparable. But there are those industry challenges still there, around your tactical solutions against strategic solutions. So I think, this is the beginning of the journey, and there's going to be still quite a bit of spend to get you where you finally need to. I feel like we've had a foot on the ball moment where people have stopped because they've got some results out, and they're maybe going back to boards next year to get some more income to actually carry on this journey, because a lot of this stuff is very expensive, in particular the systems. And as I mentioned, the number of people as well, the scale of that, and they're often expensive resource. So those are the kind of things I've seen. Natalia, anything else you'd like to add, please?
I want to add that the overall change to financial statements, of course, is significant. But at the same time, it would vary. The amount of change would vary from company to company, depending on what portfolios of business, what portfolio compositions they hold. And if certain companies held business that mainly under the old IFRS showed profits upfront and were heavily geared towards those types of products, those companies with the demand of gradual over lifetime release of profits will see biggest change to their P&L, while other insurers that were holding portfolios with already gradual products having gradual profit release, like regular premium saving products, so the changes to statements of those companies would be much smaller. And so really the underlying reason for changes we see from IFRS 4 to IFRS 17 needs to be looked at and not analyzed, and not only numbers as such. And thankfully, IFRS 17 now allows analysts to do it.
And just one thing I'd like to add as well, Natalia, there was a lot of nervousness in the insurance market about what you were going to put out there for review. So over the years, there's been sort of drip feeding of messages. This is what it's looking like. This is where we're heading. And so, you know, you've got to think ahead what you put out early and where you actually end up.
Wonderful. No, thanks so much, James, Natalia, for those insights from that part of the world. And I must mention to the participants that the teams in India and the teams in the UK are, they're quite well integrated. They're talking to each other very regularly. We are getting a lot of good insights from the UK side. And I think along with the expertise that the team has got and what, Kunj also brings to the table, that allows us, that much leverage and strength to actually serve the Indian insurance market, in more detail. Thank you so much, James and Natalia, for your contribution. If I may now invite, our guest panelists from industry, from ICICI Prudential, India's leading life insurance company, Mr. Dhiren. Dhiren, welcome to the stage.
Thank you so much, Siddharth.
Great. Dhiren, you have practical experience. In fact, a couple of questions that we have from the participants, which I'll ask you in due course, are more around the practical experience. So what was the thought process behind the planning for transition to IFRS 17, for submission of data to your JV partner? And how was this project planned? I mean, give us a sneak peek into your war room, when you were strategizing that how to implement IFRS 17. What were the considerations you as a CFO kept in mind?
Yeah, you're right. Let me put it quite bluntly. We were dragged kicking and screaming into the IFRS 17 world because we were quite content with the IGAP and IEV. We had kind of gotten used to it in the Indian environment. And as we discussed earlier, IGAP essentially was something that the finance team guys did, took one number from the actual guys, added up together and called it as PAT. And the challenge with that was we spent a lot of time, both teams spent a lot of time creating these numbers, but from an investor perspective, it made absolutely no sense. It was a massive challenge trying to educate investors that this wasn't the correct metric to look at because of the inherent challenges of IGAP. And of course, the alternative metrics that we had on IEV and VNB clearly made much more sense from valuing the business perspective. We were the first life insurer to go to market and get listed on the exchanges in September 16. And so that was a period of education to the investor audience as well as the analyst community of how you would value life insurers. And we had to get them to step away from the Indian GAAP numbers, and the IEV and the VNB numbers made much more sense to them. Over the course of time, as you had more listed insurers, the market has become a lot more comfortable. And so there came the question when Prudential spoke to us and said that IFRS 17 is being introduced across the world. We would have to participate in that, even though we did not really require that in the Indian environment. I think one of the key things that we picked up along, of course, Prudential had started before us, But when we started, I think some of the key things that we kept in mind is that this is not a finance project. This is not an actual project. Kunj put it brilliantly. This is actually a project that involves finance, actuarial, and more critically IT, because everything, as James put it, relies on the data. So very clearly, the first thing that we did was set up a common team that involved members from all of these three teams. This was carved out of folks that who were doing business as usual projects. So people who were working on IGAP, either from the actual or the finance side, were not involved on this. Even within the IT, we actually had a separate set of teams carved out specifically for the IFRS 17 project. And we created the steering committee, which was the head of finance, head of actuarial, head of IT, who were involved. And again, as Kunj pointed out, this is very critical. You need to have a project manager on top. You need to have maybe a 2-man or a 3-man project management team, depending upon the size of operations, who are basically going to go to keep everyone in check. Right from the detailed process planning as to what we are going to do at each and every point, to flagging off across the board the gaps in our current deliveries. So that was extremely critical. So this set of 4 teams, so to speak, was things that we put together. The other thing that we did was quite critically make sure that all of these 4 teams met regularly and together. This is not a finance team catching up and figuring out where we are along the process. This is not IT catching up separately, nor is actuals catching up separately. Everyone caught up in the same room together. You spoke a lot of words and a lot of acronyms, which some of your colleagues did not understand, of course, at the start. But I can assure you, as we have gone through the journey, all of the folks who have been involved in the project do understand far more. So the finance guys understand how the actual numbers come through. Of course, they didn't do the math. The actual guys understand how that impacts the financials and where any change in the model makes sense. The IT guys understand of course, they may not make sense of the full set of numbers, but they do understand how do the data that they have generated and brought together, how does that flow into the entire set of financials? And they're looking at this in a coherent fashion. Very simply put, for instance, one of the conversations that we had was IT took its own time to finish reconciliation and deliver the right set of data. The finance guys were screaming at the top of their head saying, I don't have data. What am I going to do about it? Actual guys were screaming because I don't have the relevant data to be able to create the future cash flow. So when IT looked at it, they realized that a little bit of delay at their end actually impacts multiple teams, is when there is a shared understanding of each and every part of the process. So clearly putting people together in the same room made a lot of sense. And I think it delivered a lot of value for the project itself. The other things, of course, tracking each and every part of the process became that much more critical. And I can tell you, even as we have delivered the set of results, and I think we're the only life insurer in India who's finished IFRS 17, we've gone through 3 half-year cycles with Prudential. We're still learning. There isn't a cycle when we learn something new about how we are looking at IFRS 17, a lot different from what it was when we used to look at IGAP. Obviously, it's a lot more closer to the way we used to look at it from a VNB EV perspective, but there are so many more components that are different in IFRS and that one needs to manage differently. So a lot of learning along the way, but I think we were asked this question in another industry forum as to how do we start? And then my simple answer to this is just start. When you start with this principle that you've got to put all the relevant teams in the room together, and you've got to be able to get a project manager to manage this outcome, you will realize that the answers are there within the room itself. And people just have to put their heads together in that room and you realize that these are the stumbling blocks. There is enough knowledge across the industry. Of course, when we had started the journey, we had to rely on Prudential for a lot of the inputs. But if you look around now, there's a lot of knowledge that resides with consultants, with industry participants, and then on. So my recommendation is just start. You should be able to get through this. And of course, now IID has set a timeline, so everyone's on the game now.
Right. So I think what we hear is that IFRS 17 is good for the culture of an organization. It brings people together. So that's good news. even if it's tough. Then what about the internal control system? You talk about IT, data, and so many people, and I'm sure the processes, they may have to be relooked at from a very different lens now. So does the internal control environment, which is so critical to a large organization like yourselves, how does that really evolve?
Siddharth, you touched upon an extremely important point, and I forgot to mention this. We had IFC team in the room along with the finance, actuary, and IT guys. So this was something that we had embedded right at the start, because we were clear that we did not want to deliver out an outcome and then go back and figure that we had a missing link in the form of an IFC element there. So these people were in the room. Of course, in the initial part, they were understanding, but in the later part, they were the ones doing the tick boxes and ensuring that the processes were compliant with the standards and that there was no gap at all in the entire outcomes. So very clearly, IFC is a core element. The other thing that we also work together, and this is quite pertinent because you're trying to put together a system that is fairly new. You're trying to put together a bunch of results that nobody's seen before. And so to that level, if you're trying to have these conversations around what is the level of data that you have, what is the quality of data that you have, it requires people from across the organization stepping in and giving you that information, because very clearly you would have had teammates who have moved across sub-departments, who may have moved across finance and actual, which we do have enough examples of in our organization. People were in a position to come back and give you information about the quality of data, how clean the data is. And this is one of the core elements, right? Because the standard requires you to apply it retrospectively, ability to be able to generate that data from inception, as well as then apply all the models from the start, is the core challenge. And for that matter, if you've got data in a specific form, are you able to backfill certain elements? Are you able to make model changes? And then ensure that you've got enough information to be able to calculate CSM balance at this point of transition more appropriately. Those are some of the things that we had to go through, and we spent a lot of time on that front. It was one of the biggest elements that we had along the process, trying to look at data, understanding where the models were, what were the gaps in the model, remodel, and ensure that you're seeing the relevant outcomes. Even beyond that, as you have applied the CSM engine and you look at the outcomes, at some level, one of the simplest things that we said is, if you don't understand the results, think of it as a VNB EV movement. Are you expecting the same kind of movement if this were in the VNB EV world, even though the maths is slightly different? And when you apply that lens, you realize that if there was an error in the process that you had applied for IFRS, you're able to catch that far, far quicker. So you can remodel and re-estimate and bring that correction back on track far quicker. Because the challenge is you are unfamiliar with those set of numbers, but you are broadly familiar with the movement, especially companies who have been working with the embedded value and VNB, do understand the way each segment would move. But if you're able to track that into the IFRS world, you have a broad sense of how things would be able to pan out. So those are some of the checks and balances that we put in place to be able to understand what these results meant and how we could actually look at building those out. There are, of course, other challenges that we faced along the way. People challenge is a core one. James spoke of a 100-man team. No, we didn't have the luxury of setting something of that nature. I think at best, between us and the consultants who helped us, I think we had probably about a 25 or 30-man team. And we delivered results in 1.5 years, actually looking at 10 plus years of data and running retrospective from that point onwards. So which pretty much captured most of the CSM, most of the WIF that was available at this point. So fairly intense work, and then I completely echo Natalia's point where teams do get tired, teams do get exhausted. How are you going to manage that? That becomes another challenge along the way. One thing that we thought was quite important over there was to actually rotate. You are not going to be stuck in the IFRS project for too long, because it's not just the learning, it's the fact that it does get exhausting. And from perspective of creating a bench, I think it was fairly critical for us to be able to rotate folks, not just within finance, but in actuarial and IT as well, such that everyone is well versed with this. And I think of this as a very important element, because this is now going to be BAU from April 25 onwards. So the sooner you're able to integrate more parts of the organization into IFRS 17, it becomes that much critical for us. We're just running, two P&Ls till then, but from 25 onwards, we will be on one P&L. So that's going to be that much easier for everyone else to align with. So that's been the broad sense that we had to work with. And I think, have we gotten there? James gave a very good point. Working day timetable. James, IFRS 17 working day timetables are nowhere close to how we deliver on Indian GAAP. But it can only get better with time. As you get more people involved, as you fine-tune your processes, it does get better. But yeah, it's a journey.
And those are absolute gems, Dhiren. I think we all got to remember invaluable, insights. And then, so a few questions, and I think those are mostly directed at you. Very seldom you get to catch hold of a CFO like yourself, and will not lose that opportunity. So, few questions from the audience. One of the question is around, what do you see as an additional challenge for the Indian insurance companies, which are subsidiaries of banking companies like yourself, So what are those specific challenges? Now, banks are obviously still on the traditional Indian GAAP, and you guys moved to IFRS. How do you see that, the parallel P&L that you're talking about?
Yeah, I know. This is a point of conversation with our primary promoter as well. The advantage that we see at this point is slowly RBI has been mandating elements of IFRS 17 as part of IGAP on the bank side. Sorry. So to a large degree, some of the elements that you're looking for are already baked in. But I think the key thing to look at is how do we actually consolidate? I don't have an answer on that yet, but I think this is still under discussion.
Right. And just from the shareholders' perspective, I mean, how do you see? We asked this question, to James in the UK context, but how do you see from a shareholder's perspective that value changing, and should they see this as a favorable change? They see everything in terms of the market capitalization or the value of their shares, the value of their investment. How do you as a company and CFOs are expected to convey that to the stakeholders, to the investors? What are those communication strategies that you guys are working on?
So we haven't gone to market yet with these sets of numbers. We've had conversations with Prudential. I'm so sorry.
Please.
We had a conversation with Prudential as part of consolidation. I think one will have to understand from an analyst perspective and investor perspective, the new set of P&Ls will make far more sense than what it is right now. So I guess we will move rather than far more smoothly to this metric. It will require a lot of education again, just as we've done with when we've gone to market with IEV and VNB. It will take a little bit of effort, but I think with more companies along with us, I think it'll become that much easier on the way. So with our stakeholders, we've done a couple of conversations with our internal management, getting them to appreciate what this new metric is. And there are some fundamental points that Natalie also pointed out. The separation of insurance and reinsurance contracts, for one. The call out of loss components is another. These are key things that one would be looking for. And the greater transparency that comes through from a IFRS 17 P&L, that essentially means that business is going to be that much more transparent. The way that you manage the business automatically changes. I don't think it fundamentally changes our strategy. We will do what is right from a customer perspective. We will do from an opportunity perspective. That doesn't change that. The way that we actually run the business does not fundamentally change. The way we represent the business to the external world does change. And to that extent, there are a couple of points that management would be far more cognizant of. And that's part of the education of along the way.
Right. I'll ask you one more question before I let you go. We have this event live on LinkedIn, and one of the questions that posed there is that what challenges industry will face while developing the IT systems? I mean, people want to know, is this a complete revamp? Can they bolt on something to the existing system? What are the challenges you guys faced?
Yeah, These systems are completely new. So you will have your core systems, you will have to have another CSM computation engine. And I think along with just the CSM computation engine, you'll have to understand the trace back of the results. That becomes far more critical. There are multiple systems that are available in the market at this time, which will give you that visibility. Because as you're able to then manage the P&L, as a CFO, one thing that you want to understand is what caused what. And therefore, what is it that I can change going forward, which can give me a desired result. So traceability and backtracking of the results becomes that much critical. So it's not just the core CSM engine, it's beyond the CSM engine, understanding what were the core drivers. Those become important. So will they bolt on to what you have? I guess in some level, this is another set of systems altogether. So you will have your current set of systems in place, but you will have this in addition to that. So from that perspective, as James also pointed out earlier, cost is another consideration that one should take into account when you're bringing out the project plan. The project management teams, one of their jobs would be ensure that you stay on cost, because it's very easily can overshoot the benchmark that you set out.
Great. Thank you, Dhiren. I think a lot of practical inputs, from collaboration to systems to, making an overall sense of the numbers and not getting really swayed by the technicalities, but also, being able to stand back, look at the figures and see if they really make sense in the context of the business. But great insights. Thanks, Dhiren, so much for joining us today. If I may have, Keyur now, to bring in the perspective from the profession. Keyur, how do you see this move from IRDA side to make IND AS applicable to insurance industry in India?
Yeah, so Siddharth, we got a lot of understanding and learning from actuarial world and from in Indian scenario, from what Kunj explained and also what James explained from a UK perspective. I guess we all know that India committed to global investor, that as a nation will move to similar accounting standard where a person from any part of the earth can understand and see the disclosure perspective, compare the financial statement of Indian company as well as global companies. And that scenario started from 2016, where Indian corporates started moving. Gradually, we got all kind of corporates into the world except insurance companies and a banking company. And Dhiren rightly mentioned that banking companies are moving into a piecemeal manner. We got ECL discussion paper, we got master circular for banking on fair value, on some of the aspects of IND AS 109 or IFRS 9. So I guess IRDA also kind of taking insurance company into the global path of IFRS 17. They have issued a glide path where they have asked 15 corporates where they have a partner who are global partner. And they want to get the learning leverage for an Indian economy. So once we move towards this 15 companies learning process in India, the regulator will see the kind of estimate judgments they are taking, and then eventually it will roll out to all other insurance companies in India. I guess this is a brilliant move from IRDA perspective. I must appreciate the act of the regulator. This is not only an advantage giving to insurance corporates to learn and leverage from the other market, but also to safeguard the implementation project from a cost perspective, as we understood from Dhiren that IT system, the internal control evaluation, the reporting, the investor communication, all this will take time. And all this, how to do it in an effective manner for a developing country like India, we have to leverage on a larger aspect of a global economy. So I truly believe that what IRDA is doing is absolutely brilliant, and actuarial world gives a lot of judgment and estimates, unlike a normal manufacturing or an IT company where we understand by reading their financial statement. In actuarial, we also understand that right now the law which Kunj mentioned, that a lot of auditable trail, which you question asked to Kunj in terms of audit judgment of all those aspects, which even India we don't know that how IRDA is going to take place. So even for IRDA, it's important to understand that what kind of disclosures global are giving, what kind of impact it is appearing on the financial statement of the company, and then ultimately what role needs to be driven to the auditor and to the management in terms of signing of the financial statement and communication to the key stakeholders, including regulator.
Right. So in a way that would actually pave the way for the next wave of regulatory changes, and they may introduce some of those aspects as we move along.
Absolutely, absolutely. We are looking forward for a lot of guidance from IRDA in terms of presentation of financial statement, in terms of changing the requirement of existing circular in terms of valuation to moving to an IND AS valuations. So all those changes are yet to come from IRDA, and this is a basic step which IRDA is putting on the paper by getting 15 companies moved to this path, getting the learning, getting the understanding, and then roll out for a larger Indian entire economy.
Right. And 117 is not the only change that's going to hit them. There will be other associated. It's not just we are adopting. So 109, for example, or for the other matter of the standard. So how would those other IND AS standards that bring along, the complexity, how is that going to impact the insurance industry?
Siddharth, this is really a great question. When we talk about IFRS 17, everybody understands that insurance companies moving to IFRS 17. Let me clarify to all the participants, insurance companies are moving or transition to IND AS and not only IFRS 17. Indeed, IFRS 17 is around 70 to 80% of the financial statement of an insurance company. The similar way for banking, it's IFRS 9. But there are other applicable accounting standards which do impact insurance companies. Let's take example, investment portfolio of any insurance companies. They do have investment in a listed equity shares. They do have investment in mutual fund, ATI bonds, exchange traded fund, REIT for that matter, commercial paper, fixed deposits, government security, other debt securities. All this today are valued in some of the guidance from the IRDA method, which some CRISIL valuations, bond, some basic defined method of the valuation of the fair value. But when an insurance company will move to IND AS, the IND AS 109 defines the valuation methodology, which is driven by business model and other condition of whether how you are collecting your principal and interest from your investments. Not only that, there will be an ECL calculation which comes in the picture. There will be fair valuation accounting standard, which is IFRS 13, IND AS 113, which comes into picture, which defines the fair value measurement criteria for financial asset and non-financial asset as well. So we have to see this change, whether IRDA continues with the old accounting standard or they ask insurance company to move to IFRS 13 valuation accounting norms. Then it will be comparable ideally with the global parameters. Else we'll have another carve out coming in the insurance companies, which is yet to seen. We don't know that answer yet. So, and there are lease accounting standard. Every insurance companies do have a branches where they have a leases. So unlike Indian GAAP, we have an operating and finance lease concept. Now under IFRS 16, every lease comes on the balance sheet, depending on the lease materiality. If it's small lease or other lease, then you may use the exemptions. But otherwise, if it's a larger lease, you have to do the present value of those lease payment, and it comes on the books, which changes your EBITDA, because now you don't have rental expense, you have interest expense, and you have a depreciation on lease. Apart from that, you have an IFRS 10, which is a consolidated accounting standard. Since insurance companies invest into a lot of equities of a company because they have a huge fund, for that matter, let's take example of LIC. If I need to apply LIC's financial statement and see whether they control the parameter of the investee company, I don't know, it's a mammoth exercise. How much investment you have, whether you have a controlling stake, whether you have a board, governing control, whether you have a nominee director, it goes to associate accounting, which is equity investments. So every insurance company also need to analyze their investment from an IFRS 9, IFRS 13 perspective, also IFRS 10, which gives you a guidance, whether do you control, you don't control, and whether you have to consolidate or don't consolidate. Again, IRDA needs to give guidance on this parameter, because otherwise it will be a mammoth exercise for a large corporate where they have investment into large equity investment of a larger, corporates. So these are the small other accounting standard which impacts around 30 to 40% of a financial statement of a company, which includes presentation of financial statement, disclosure from an IFRS 7 perspective, a lot of other disclosures which will come, which is not part today in the financial statement, like how do you manage your capital, or how you manage your liquidity risk, your financials obligations. So all this is also playing a role when insurance companies transition from current Indian GAAP or IRDA guidance to IFRS 17 or say IND AS 117.
Right. And as a consultant, as an advisor to companies, how should they go about? We heard Kunj talk about a few things, and we then heard, Dhiren's practical perspective of, what kind of project management unit they had created. What do you see as an advisor, as, those one or two things that companies need to keep in mind to get ready, to apply these standards, adopt these reporting formats, get ready for all the disclosures well in advance before the regulatory due dates?
Sure. So Siddharth, we heard from Dhiren that it's a 1.5 year they took to initiate and still they are learning. We heard from James that it's a long project. We heard from Kunj that project management is the key, is the important aspect. So as a consultant, when we go and speak to client, it's clearly project management which divided into 4 parameters. First, as a corporate, when you are transition to any new gap, whether it's IND AS, whether it's new IT system, or whether any new parameter of internal control, you have to first do a gap analysis, which is nothing but your diagnostic study, that where do you stand today and what is requirement and what is the gap in between you are playing with. After understanding the gap, you identify what kind of systems you want to play, how you identify that gap to a quantification number so that you can communicate to your investors or stakeholders. Ultimately, eventually, it comes to a preparation of financial statement, which is your 3rd stage. But along with these 3 stages of diagnostic, quantification to a presentation, the important stage stands is building capabilities. A team has to learn technical aspects of IFRS 17 because it is not only presenting numbers in a particular way, it has to be driven with respect to audit trail, because that's a circular which MC has issued, which is applicable to all Indian corporates. It is also important aspect of internal control over financial reporting. And unless you understand that how my system is speaking to each other, how this number are appearing in the financial statement, if you don't have that trail, if you don't know the background, it is important for you to understand how you're going to disclose this information to auditor, how you're going to convince to a stakeholder that why there is a change in the number and for what reason, how you're going to do a disclosure under IFRS 7 or under financial statement about informing that which change is happening for what reason. But suddenly a company which is doing very good and they take a transition provision in a different manner for which their net worth is impacted on a high level, how are you going to communicate that? What kind of estimate judgment you took? So I guess the 4 aspects of understanding the gap, identifying the quantification, assessing the presentation of financial statement, including IT systems, and ultimately capability building. That's the important aspects that I believe as a consultant, I'll advise to my clients.
And capability building, of course, involves a lot of training and, bringing in, a lot of those technical resources at one place. Any final remarks around that, around the capability?
Yeah, so I guess there has to be a kind of a workshop which starts from the very beginning, Siddharth, where initially, since the client does not know the full gap, you give them the initial assessments, you teach them what's the difference, you give them the parallel universe of the global, that if they've reported, what kind of numbers you have got, and along with some technical discussion with them. And over a period, when you go, the workshop continues to an advanced level. And then you give them the additional understanding of communication to investor, what kind of role are we playing. Let's take one example of segment reporting. Today, the segment reporting is driven by IRDA. Now we'll have a cohort system which is coming in place. So I'll allocate my policies into a different cohort. My CSM will speak differently. When I'm speaking my segment under IFRS 8, which is IND AS 108, I have to prepare segment based on how chief operating decision maker is seeing the segment. Now, when I'm seeing the cohort in a different way, when I'm seeing the CSM of every cohort in a different way, I have to report that in the segment. That's another question. And if I have to, what kind of training I do need to communicate my clients, what kind of reconciliations I need to have in my financial statement with respect to my MD&A, which speaks to my segment. So all this kind of training is also inbuilt when a person is starting from Indian GAAP journey to IND AS and understanding all the technical parameters of different accounting standard, read with communication to investor and stakeholder and auditor and regulator.
Right. Thanks, Kiyur. I think that's very helpful. Of course, this is first in a series of webinars that we will have on this subject, and we will dive deeper into technical subjects in the sessions going forward. Thank you so much. If I can have all my panelists on the stage, just any final remark, Kunj, any last piece of advice? Of course, we will have you more often now. We will need a lot of your technical inputs into as we build capabilities within the country. But any final remarks from your side?
No, it's been wonderful. Thank you for having, and I look forward to this very interesting journey in India with the life companies. And thank you for having us on.
Thank you. Dhiren, you've had absolutely amazing inputs for all of us. Any last piece of advice that we may have missed?
So my only piece of advice is just get started. Don't fret too much about the complications.
Just do
We'll all
it.
learn along the way, and I think it'll be a good position where India is also going to have financials that are comparable with the rest of the world. Thank you so much, Fab.
Thank you. James, we'll of course be talking a lot more often now, but any last piece of advice for India?
Yes, just one little nugget that I remembered is that when all of these systems are created on your left-hand side of the calculation engine, you might be able to start thinking about having a different resource pool. And that's, more analysts just running the process rather than any of the thinking at that point in time. And we've seen one or two insurers starting to think like that now. They've got all the kit and it's all delivered. But anyhow, thank you very much for inviting us. Natalia, anything else?
Yeah, I think I can add a note to insurers. When insurers start their transition process, please start speaking early. Start speaking early to your auditors. Start speaking early to the colleagues, to your competitors. Start speaking to consultants, whether within the engagement team or whether outside of engagement team. So do not struggle alone with technical issues or methodological issues or general thinking. Oh, can I do this or I can't do this? So be sure you're not alone thinking about that issue, and sharing it and discussing it together in a group will lead to a fast solution.
Think as a group. Wonderful. Thank you so much, everyone. Have a very good rest of the day, rest of the evening, and thanks to all the participants for joining in today. And we look forward to continuing this in the future. Thank you once again.
Everyone.
Thank you.
Bye.
Bye-bye.
Bye.
Bye.